All right, so imagine this for a second. You're a high-flying executive,
Okay.
or maybe you're an entrepreneur. You finally secured that Series B funding you've been chasing for, 18 months.
You're on top of the world.
Exactly. And you decide, okay, it's time. Time to expand into the massive Chinese market.
Yeah.
You've got the plan, the local team, the capital, but then you get to the final step.
Lease agreement.
The lease. You're sitting in this boardroom, pen in hand, hovering over a 5, maybe 10-year commitment,
Yeah.
and you just freeze.
It's that gut check moment.
It is, isn't it? Because suddenly signing that dotted line feels less like a smart business move and more like you're building a house on, well, shifting sands.
Shifting sands is probably the most accurate metaphor for the entire Asia-Pacific landscape right now.
Welcome back to the deep dive. Today, we are unpacking a really fascinating and, frankly, a kind of terrifying shift in the global market. We've combed through a stack of reports on everything from foreign investment anxiety to some pretty intense new real estate regulations, and even, surprisingly, global mining rights.
And the common thread tying all of these together is, well, it's the death of commitment.
Right. We're looking at why long-term leases have become a dirty word for foreign companies in China. And on the flip side, why flexibility isn't just a buzzword anymore.
It's a survival strategy, a defensive maneuver. The market's gone from a stance of conquer and hold to something more like navigate and survive.
No, I have to tease this because when I first read it, I thought it was a typo. Later on, we are going to talk about developers so desperate they are literally giving away gold bars.
A kilogram of gold. It sounds like folklore, but it's a very real and very desperate symptom of a much bigger crash.
I cannot wait to get to the gold. But, okay, before the shiny stuff, we need to set the stage.
Huh.
Why is everyone so afraid of a long lease?
Right.
Because usually, a long lease is a good thing. It locks in your price, gives you stability.
In a stable environment, yes, that logic holds up. But the hesitation here comes down to a kind of structural uncertainty. The sources point to this core anxiety that goes beyond just economics.
You mean the political and historical fears.
Exactly.
The reports mention this idea of colonization and annexation, which I have to say sounds incredibly dramatic for a commercial real estate deal.
It does to Western ears, but you have to look at the precedent. When a foreign entity controls a huge chunk of land for decades, it triggers a political response tied to the century of humiliation.
So the fear is that it sets a dangerous precedent.
It's almost like a slow-motion annexation in their view. So a foreign company signing a 30-year lease isn't just a tenant.
They're a geopolitical symbol.
Precisely. You are stepping into a politically charged space just by being there. And then there's the environmental angle, which the sources really hammered home.
Yeah, that analogy was striking. It was like renting a house, you're getting evicted from in 50 years.
Right. If you know you'll never own the land because the state owns the land and you won't be there forever, how do you treat it?
You treat it like a rental car. You drive it hard.
The fear is land depletion. You extract maximum value, pollute the water, maybe, because the long-term consequences, they just aren't on your balance sheet.
So the tighter regulations aren't just bureaucracy.
No, it's protectionism for the physical land. And it's not just the land, it's the people on it. The labor influx.
The human element.
Yeah. You sign a lease for a massive factory, you aren't just bringing in machines, you're bringing in an army of workers.
And they're often not locals.
Thousands of them. Migrants, specialized workers. It completely strains local resources, hospitals, schools, water. It creates social tension.
If I'm that executive, I'm realizing my signature triggers political fear, environmental scrutiny, and social tension.
That's a lot of baggage for a lease.
It is. But that's only half the story, right? Because even if you ignored all that, the market itself is, let's say, wobbly.
Wobbly is a very polite way to put it. The sources describe a full-blown crisis. And to get it, you have to understand the 3 red lines.
This was the turning point.
Yeah.
I see the term all the time, but the reports we read really broke it down. This wasn't a suggestion from Beijing.
No, it was a hard stop.
Yeah.
In August 2020, the government basically said property developers have way too much debt. It's a bubble. So they introduced this policy to force them to deleverage.
And these were specific financial metrics, right? Not just a vague warning.
Very mathematical.
Yeah.
1, your liability asset ratio had to be less than 70%. 2, net gearing ratio under 100%. And 3,
You had to have cash on hand to pay your immediate bills.
A cash to short-term debt ratio of more than one.
Right.
Exactly. And if you cross those
No
lines,
more borrowing. They took away the credit card.
they cut it up. And
Mhm.
for developers whose whole model was borrow to build, sell to pay back, it was catastrophic, a massive liquidity crisis almost overnight
And this is what led to those ghost cities we've all seen footage of. Half-finished towers just stopped.
because the money evaporated. They couldn't pay contractors, couldn't pay suppliers, and crucially, couldn't finish the apartments they'd already pre-sold to people.
Which brings us to the desperation. Because when you can't borrow, you have to sell. But consumer confidence is in the tank.
So you have to get creative.
Very creative. We're talking free cars, free smartphones.
Those are the mild ones.
Right. My absolute favorite detail from all the research in Hangzhou, one developer was offering up to a kilogram of gold.
A kilogram. That is a significant amount of money.
It's absurd. Imagine walking into an open house and the realtor says, "Sign today, here is a literal brick of gold."
It screams that the asset itself isn't worth the asking price. They have to bribe you to take the risk.
And that risk spread, didn't it? The reports talk about a domino effect hitting the shadow banks.
This is a crucial piece. A lot of the funding came from trust companies, wealth management products.
The high-yield investments regular people put their savings into.
Yes. And those products were heavily invested in real estate. So when the developers couldn't pay, the shadow banks wobbled. Investors couldn't get their money out. It was classic contagion.
And the numbers are staggering. The property sector's contribution to GDP.
It dropped from about 24% in 2018 to an estimated 19% in 2024.
That's 5% of the entire economy of a superpower. Just gone.
It's an unprecedented contraction. So back to our executive. Why would you lock yourself into a 10-year lease in a sector that's actively shrinking?
You don't buy a ticket for the Titanic after it hit the iceberg. But it gets even worse because the ones who really needed those land sales, it's the government itself.
The local governments specifically.
This part really surprised me. I just assumed governments made money from taxes.
In China, for years, local governments have relied on selling land use rights to fund their budgets. It's this revenue addiction.
How much of their revenue?
Often 30, even 40%. It's the engine that paid for all those incredible subways and high-speed rail lines.
So they build infrastructure. That makes the land valuable. They sell the land to developers.
And use the money to pay for the infrastructure. It's a cycle. Or, as the sources put it, a house of cards. Because what happens when the developers stop buying?
The cycle breaks, the money stops flowing.
But the debt for the bridges and subways is still there. Which leads to this terrifying acronym, LGFVs.
Local government financing vehicles.
Exactly. These off-balance sheet entities cities use to borrow money. They're sitting on a mountain of debt. And their main income stream just dried up.
And the kicker from the report is that Beijing has signaled it won't necessarily bail them out.
They're forcing accountability, trying to break that moral hazard, the idea that the central government will always write a check.
Which, for an investor, adds another layer of terrifying risk.
It does. You're not just betting on the real estate market. You're betting on the financial health of the entire city you're in.
Okay, let's pivot. Because so far it's been about foreign companies being scared of China, but the research showed this isn't a one-way street.
No, it's not. It's a mirror image.
Chinese companies are facing the exact same issues when they try to go abroad, especially in mining.
Makes sense. China needs copper, cobalt, rare earths for its EV industry, and they have to get it from Africa, South America.
But just as China scrutinizes foreign leases for national security, other governments are doing the same thing to them.
The U.S., Canada, Australia,
Yeah,
they're all launching these national security reviews on Chinese investments.
it's tit for tat.
It is.
Mm.
And the definition of national security has expanded. It's not just land next to a military base anymore. Now it's critical minerals, tech.
So a Chinese firm tries to buy a lithium mine and suddenly the government steps in and says, nope, strategic asset.
Exactly. And even when deals get approved, the market volatility kills them. Commodity prices fluctuate, and suddenly the deal looks bad.
They use the material adverse effects clause to get out.
That's the escape hatch. They argue something catastrophic has changed, and it all ends up in messy, costly arbitration.
So the shifting sands feeling, it's everywhere. The whole era of easy global integration is fracturing.
Long-term has become a liability globally.
So what's the solution? I mean, you still have to do business. You still have to go to Shanghai.
You do. You need boots on the ground. And this is what's fueling the rise of the agile workspace.
Okay, let's talk about that. If I'm that executive and I'm scared to death of a 10-year lease, what are my options?
The market is pivoting hard towards flexibility. In places like Shanghai, companies are rejecting the old model for flexible office space and serviced accommodation.
And the old model was brutal, right? A 3, 5, 10-year lease? Huge security deposit.
And you often got a shell, a concrete box. You had to pay for the entire fit-out, the walls, the floors, the internet, a massive capital sink.
And if the regulations change a year later, you're stuck with that sunk cost.
You're trapped. The alternative serviced offices, co-working, extended stay apartments, it completely mitigates that risk. You're talking monthly or yearly commitments.
And everything's ready to go. Internet, reception, you just plug in your laptop.
It lets you test the waters, you can enter the market, and if things shift, you can pivot. You aren't married to the real estate.
You know, this whole pivot to agility, it's exactly why we're seeing this resurgence for platforms like moveandstay.com.
Oh, it makes perfect sense in this context. Absolutely.
Yes, because they've been doing this for over 25 years. They aren't some startup chasing a trend. They were connecting business travelers with these kinds of extended stay solutions long before the 3 red lines was even a term.
And that experience matters when a market is this volatile. You want a provider who actually knows the landscape.
Exactly. They specialize in that sweet spot serviced apartments, hotels, serviced offices. It's trusted by corporate teams and entrepreneurs because it just takes the friction out of it.
And really, using a service like that is a form of risk management. You're outsourcing the asset risk to them. They deal with the landlord, the compliance, the bills. You just pay a fee for the flexibility.
It removes the real estate headaches so you can focus on the actual business.
And in a market like this, keeping your capital agile is the smartest move you can make. You don't want it tied up in drywall in a building owned by a developer who might go bankrupt.
Agility is the ultimate safety net. I like that.
It really is. We're seeing this fundamental shift. Historically, owning the building, having that long lease, that was a sign of strength.
A status symbol. Look at our tower.
Exactly. But now, in this volatile world, that tower looks less like a fortress and more like a prison.
A very expensive prison.
Right. Long term is an anchor when you need to be a speedboat.
That's a powerful way to put it. So for our listener, the takeaway is clear. If you're looking at Asia Pacific, don't fall in love with the real estate.
Do not get seduced by the developer offering you a gold bar.
Even if it's a whole kilogram.
It's a nice paperweight, but the smartest move is finding a setup that lets you adapt as fast as the headlines change.
It's all about being able to pivot.
The market is pivoting, and you need to pivot with it.
So we've covered the fear of colonization, the 3 red lines crash, the local government debt trap. It's a landscape of instability.
It is. But instability creates opportunity for those who are fast enough.
And it seems like the survivors are the ones that don't plant their feet too deep in the concrete.
That's the key. Resilience now comes from adaptability, not immobility.
I think that's a perfect place to wrap the analysis. But before we go, I want to leave everyone with one last thought.
What's on your mind?
Well, we said the property sector used to be almost a quarter of China's GDP. It was the engine. And now it's stalling. Local governments can't rely on selling land anymore.
That engine is running out of fuel.
Right. So the question is, what comes next? Where will the next massive engine of economic growth come from to replace real estate?
That is the trillion-dollar question. And that transition is going to be messy.
And more importantly, when that new engine does arrive, will you be agile enough to jump on board? Or will you still be stuck in a 10-year lease in an empty office building?
Something to think about.
Thanks for diving in with us today.
Always a pleasure.
See you on the next Deep Dive.